Hello and welcome, traders. I am Rachel Deshelle, your host for Long Options here and a Senior Manager of Trading Services. Now, this is a class where we make the assumption that you are already familiar with the basic concepts of options. We're going to build on those and talk about directional strategies using long calls and long puts. We do have Kevin Horner there in the chat, my good friend and colleague. So please feel free to chat in your questions, comments, requests throughout the session today. Please follow us both on X. We both post a ton of charts. So he is Kevin Horner CS. I am Rachel CS. Please give us a follow there. And please like and subscribe to this, video and subscribe to our Trader Talk Schwab Coaching on YouTube. Well, you asked, we answered, we are about to deliver. We are going to cover leaps today. So like John Forrester said in the chat, start leaping for joy. So many of you have asked to cover leap options strategies. So we're going to go through 3 different example trades today on leaps and run through a leap scan as well. But before we do that, let's jump into some important disclosures here. So options carry a high level of risk and are not suitable for all investors. The information that we're going to cover is for general information, educational purposes only, should not be considered a recommendation or advice. And the paper money software, it's for educational purposes only. We're going to place some trades using that software. Keep in mind there are some differences between paper and live. So as far as our agenda today, we're going to start with our lovely market overview and review past trades that we have placed in this class in the past few weeks, I guess just last week. And then we're going to go into the discussion of long options, price, time, and volatility, those factors that affect the pricing of an option. And we're going to place 3 example trades today. So I'm going to dive into Thinkorswim, and let's just start with the S&P 500. Well, we reached new all-time highs yesterday after breaking out of this zone of resistance here. It's been a good start to January so far, which we see there. We can see below, market breadth is definitely confirming this move to new all-time highs. This is just the advanced decline line here. It's probably one of the most popular measures of market breadth. It takes all of the stocks on the New York Stock Exchange that are advancing and subtracts the stocks on the New York Stock Exchange that are declining. And it gives us this nice line here, which shows that market breadth is indeed improving. We have more advancers than decliners on this advance in price. So that is definitely a confirmatory signal here. Look for new support being that breakout around 6,900 or so. Now let's take a look at the Dow Jones Industrial Average. We are also seeing a breakout on that. We made new all-time highs yesterday. We did have a bit of a, I would say a shooting star candle here in this case, or no, this is a hanging man candle actually. So where we have a little body at the very tippy top of a very long candle with a long lower wick. We have that hanging man there, which is typically a bearish reversal candlestick that you do see at tops of a trend or tops in the market. We did have a little bit of follow through today where we're seeing a bit of a bearish engulfing candle. Now we won't get the follow through of this specific candle until tomorrow if we do trade above this prior high, which would give us indication that it invalidates that bearish engulfing candle. But in the near term, traders may be looking to find support right around this 48,800 zone, where we had a little bit of a consolidation move and a retest just last week. So keep an eye on that as well. NASDAQ working its way through this ascending triangle pattern, continuing to coil for us. It definitely closed that gap back from November 4th that we see there. So that's going to be really the biggest resistance level to get its way across to possibly make its way to new all-time highs there. So let's go into reviewing some of our old trades from last week, ones that we placed. We placed 3 different trades. We did get stopped out of one of them. Maybe we should start there. So let's start there and look at the one that we got stopped out of. So we placed an order for eBay to buy 14 contracts to open the 20th of March 2026 90 strike call. We entered in at $7. We actually got stopped out. Looking at our downside, I'm going to make this easier for you guys to see. We got stopped out right around 595 or so. So we did, that was kind of one of the things. We did have a pretty tight stop, probably a little bit too tight in this case if we're kind of taking our learning lessons, writing down in our trading journal what went wrong, what went right. That would probably be one of the things that we would write down to kind of make sure for next time, is to not have as tight of a stop in this case, maybe widen it up just a little bit, as long as it's still in our risk parameters for our account. Because if we look at the technical setup for eBay, and I'll show you guys this on the chart here, there is no structural change in trend. We just had too tight of a stop. Here, let me remove some of these studies so you guys can see this a little bit better. So this is essentially where we got stopped out at, probably one of these 2 days. You can see price, all it did was create this bull flag and then move to the next one. So if you placed your stop a little bit lower on that paper trade, kudos to you. You probably didn't get stopped out, but that is one of the downsides of placing too tight of a stop. You can see you can get whipsawed out of that trade, even though it makes that next move higher there. So kind of learning learning kind of metric there with that one. Now let's look at some of the other trades we're still in, because I do see a couple questions there in the chat. We're getting to those ones here that we are still in and profitable on. So let's take a look at FedEx. We were long 4 contracts of the 20th of March 2026 290 strike call. We were definitely up on that one quite a bit, down on the day, but the uptrend there is still in place. We can look at the chart in just a moment. Rocket Lab, same thing. We bought the 5 contracts of the 20th of March 2026 75 strike call. We're up on that one as well. So I'll look at the charts of both of these just to remind some new viewers of what we saw on the chart that led to these possible trades. So with FedEx in particular, we saw that we had a big base, long-term uptrend here. We saw a retest of support, which gave us that indication of that possible move higher with the already existing uptrend. Now we're seeing almost like a little bit of a flag or pennant pattern, but that is what gave us the reason to enter that long call trade. And let's look at Rocket Lab, the other trade that we have. So we were looking at a few different things for Rocket Lab. We did draw, I don't know if this was this past class, but I did draw some Fibonacci's on this one as well to kind of give some targets to the upside that traders may be paying attention to. But we did see this big bull flag pattern here that didn't retrace more than half of the move. We saw that break above resistance yet again, and we decided to have enough conviction to take that trade there. Kevin mentioned he had the same strikes on eBay and did not get stopped out. Well, you are lucky there, sir. You are very lucky that you did not get stopped out, because unfortunately I did. I was, I guess, the unlucky one in that case. So kudos to you and your stop order. You're still in that trade. Let's see if we have any other questions in the chat. Okay, it looks like we're good to go. So let's get into those leaps, because I want to save a ton of time for those today. We have 3 example trades. We want to run through that scan of leap options. We don't cover leap options too often in this class, but when we do, I know everyone's asking for them, especially in the survey. Everyone has been requesting leap options recently, so I want to make sure I deliver on that. So let's talk about what leaps are. So if you're not familiar with what leaps are, they're essentially long-term equity anticipation securities. So they have a year or longer expiration. And when we think of these as essentially like our long-term investment style way of trading options. So typically with short-term options, we are swing trading, medium-term options, a few months out, is in essentially trend trading. Think of leaps as putting on the mindset or cap of a long-term investor in this case. Now, there are obviously a few differences between leap options and being long the actual stock. We definitely don't have voting rights. We're not entitled to dividends, things like that as an option buyer. So keep that in mind. But there are some different pros and cons with leap options. Some of the pros are with having more time for that asset that you're trading to move in that desired direction. You're giving yourself more time, more days till expiration for it to meet that price objective. Another benefit or pro of trading leap options is that is the factor of volatility. So with shorter term options, you're always on the lookout for an upcoming earnings date. You're always checking the fluctuations and volatility to make sure it is a low IV environment to be able to buy options in at a little bit of a cheaper price where it gives you that type of market environment. In the case of leap options, you're going to be holding this option essentially, ideally, through multiple series of earnings announcements in that case, so volatility will not impact it as much. I'm going to go on mute here for a second to cough. I may do this from time to time, so bear with me. I guess I was not muted in that case, so sorry guys. I am still coming back from bronchitis, so it's just something we're dealing with here, so sorry about that. Now, another pro of leap options, you can control a larger position in that underlying with much less capital. So that kind of speaks to just the capital efficiency nature of options in general, but you can hold that long-term position and you won't tie up so much capital over time. So that's another pro. Another one, since the option is obviously going to have a lot more days till expiration, it will not be as sensitive to measures of time decay or theta decay on that option like we talk about as well. I did just see a survey get posted in the chat, so please fill that out. I know you guys filled it out last time, and I really appreciate it, and that's why we're talking about leap options today. So I definitely read all of those comments and questions in there as well, so please definitely take a minute to just answer those 2 questions in there. So we talked about the pros of leap options. Let's talk about some of the cons of leap options. So on the other side, they're going to be a lot more expensive than short-term options. So definitely be prepared to pay a pretty penny for these. Still not compared to holding the underlying stock, but compared to short options, they are going to be more expensive, or short-term options, I should say. One that we already covered, no shareholder rights, no dividends that you're entitled to, as you would be with stock ownership. Another one would be larger, or I guess in a sense, lower liquidity. So with some of the near term options that we trade, where we go a couple months out from expiration that you guys have seen in this class, we're looking for those higher levels of volume and open interest. You're not going to see that nearly as much in the long-term options. And that's just because some of the near-term options, the weekly options, are going to be a lot more liquid in that sense. Now, as far as volatility, we talked about how you don't necessarily have to, we're not going to necessarily pay attention as much to the fluctuations in volatility because it's going to happen all throughout the year. Longer term options do have a larger vega. So when we dive into the option chain, you will see that they will have a larger sensitivity to the underlying stock's implied volatility just because of that larger vega. And another one would be, or I guess kind of the last con would be their availability. So they're not necessarily available for every stock every index, just kind of like weekly options are, same type of thing. Really your more liquid options are going to be the ones that you are going, or your more liquid stock, I should say, are going to be the ones that offer leap options. So we're going to build this scan, which you guys have already seen here on the screen. I did that on purpose, so you can see what type of filters we are placing in here to scan for a couple leap examples here. And the reason why we do have a couple fundamental filters on here is because over the short term, we don't talk too much with trading about fundamentals and things like that because we're naturally just trading the trend in this case. But in the sense of leap options, the fundamentals are going to matter a little bit more because you're obviously going to hold this stock through multiple quarters, multiple earnings announcements, revisions, things like that. So the fundamentals will matter a little bit more in this case, which is why we're going to place some of these fundamental filters into our scan. So essentially what we did here was I am scanning in all listed stocks that are greater than $20. We're going to look for stocks that have a positive earnings per share, and hopefully they will be growing their earnings over time, since that's typically what we see with movement in the stock price as well. Kind of one of those factors fundamentally we may plug in here to look for the long term. A return on equity here as well. It's just looking for a return on equity of greater than 10. That really takes that net income divided by that shareholders' equity. It's really used to just compare that company's profitability over time or against its competitors. And so if we find that higher ROE in that case, it's going to be indicative that a company is just better at using that equity to generate profits in that case. So that's why we're going to keep it at 10. We're going to look for an average volume, 50-day average volume of greater than 2 million shares traded in this case, to look for more liquid stocks than we necessarily would, so we can find those with liquid enough leap options in this case. And then the last one here, since you can't really see it too much, we are just looking for stocks that are above both their 50-day and their 200-day simple moving average. Since the 50-day is roughly about close to 3 months of time, the 200 is close to 9 months of time. We want the long and intermediate term uptrend to be intact there. So that's going to give us about 99 to choose from. So I'm going to share this scan query with you all. I will put this in the description of the video as well. So this is going to be the scan, and I'll place that in there. So we're going to take some of these examples and we're going to look at the chart of them. We're not necessarily going to dive too much into the fundamentals today to just save time. We definitely recommend using both fundamental and technical analysis here for your research here at Schwab. But let's just look at a couple of these on the chart. So one of the results that came up from this scan was Merck. So I'm going to take a look at Merck and just look at the long-term trend in Merck. And if I'm actually looking at being a long-term investor in Merck, because that's the hat that we're putting on today, reminder on that, we are looking to essentially be a long-term investor in Merck. So if that's the case, I may even back my time frame out to a little bit longer than a year just to see what the long-term trend has looked like in Merck. And really since mid last year, it has been on an uptrend from these lows and has touched support just recently over the last few weeks, and it's made its way up to this other familiar level of resistance here that we see a couple times. It definitely has based on the trend, if we kind of look at some of these other resistance areas that it may see in the near term here, or I guess in the long term, I should say, 120 may be a resistance level, and then these all-time highs around 134 may be another resistance level as well. But the trend has definitely showed us that it has turned around this year for sure, and we are seeing yet another support retest just today for us to give us a way to enter back into this trend on Merck for the long term. So since we talked about us not really paying attention as much to IV, as much to time decay and things like that, let's move over to the trade tab and let's look at a long-term option in this case. Well, I guess we're not paying attention to IV, but we are looking at the IV percentile, smacking us in the face right there of 16. So it is still a pretty low implied volatility environment for Merck in general. But let's look at a LEAP option that's going to be more than a year to expiration. So that's one of the things we're going to look for with these LEAP options. We're going to look for greater than a year to expiration. We're going to look for an option with the delta in the 60s in this case as well. So an option that has some intrinsic value that is going to catch a little bit of a higher move on our option theoretically if we should see a move in the stock in our direction. So let's take a look at the 17th of June 2027 with 520 days until expiration. Give me just one moment here. Okay. Excuse me. So let's take a look at Merck's option chain here. And if we're looking for an option that is slightly in the money, does have a delta of in the 60s, but also a tight spread. Let's take a look at what we see here. So we do have quite a bit of open interest in these options, but very light volume, which we talked about in the beginning is kind of to be expected just because these are a lot more lightly traded than some of the near-term options in this case. Now, some of these spreads are a little bit wider than desired because one of the other things we always tend to look for is a bid-ask spread of 10% or less. So we want to make sure that we use that as the first indication for liquidity, not necessarily volume or open interest, but looking at a tight spread on the option to give us that number one sense of liquidity here. And I can see here that we have a pretty tight spread on the slightly in the money option here at 105. We also have a pretty tight spread on the 95 as well. So since this one's pretty close to 60, it's at 59. Let's use that one in this sense. It has a little bit more open interest than the other one as well. It has a little bit of volume today, and it's delta 59, which essentially just means that per $1 move in the stock, this is theoretically how much our option is going to move. So if Merck goes up $1, all other factors stay the same, our option should theoretically gain 59 cents there. We can see that there's little to no time decay at all, but our sensitivity to a 1% change in implied volatility is going to be theoretically 48 cents on that option in this case. So I'm going to look to buy this option here at the 105 strike. And whoops, I'm going to right click on this, go to buy custom with stop. Okay. Now we're going to link a few things together here. We're first going to make these good till canceled, and we're first going to bump up the number of contracts to 4 in this sense. So we will be looking to enter the trade today on a little bit of a pullback since it meets our technical factors and our fundamental factors. And just a reminder of what those are. We have that list to the scan that you can pull up there, but essentially these are the factors we're looking for. Positive earnings per share, return on equity greater than 10, moving average of volume is greater than 2 million shares traded on the underlying, and a stock that is above its 50 and 200-day simple moving average here in that case. So hopefully that answers that question. I am not looking to buy a vertical today because this is a long options class. We're here to trade long options. So if you would like to learn more about verticals, we do have a verticals class where you can learn all about vertical spreads and directional strategies there. But today we're going to strictly be talking about long options in this class. So I hate to disappoint, but we are covering the fun topic of leaps. So our entry is going to be around 610. And what we're going to do in this case is we are going to place our stop to the downside at roughly 80% of our entry price. So I'm going to take 1610. Actually, I'm going to try for the midpoint. So we're going to put this at 1590. 1590. I'm going to take 1590 and I'm going to multiply it by 0.8. Okay, so that's going to give me roughly what 80% of that value is. So a 20% stop in this case. And I'm going to use a stop limit in this sense. So our stop, or just our activation price, is going to be around 1272, okay? Reminder that a stop is just an activation price for another type of order. If you're doing strictly a stop order, that's going to be a stop market order. In this case, we want a little bit more control over the price, so we're going to use a stop limit order. Now, as options traders, we also need to remember that stop orders trigger off of the asking price of our option. Remember, the ask is always going to be greater than the bid. So when we look to place this limit order that's going to trigger after the stop, we may want to place, as a trader, we may want to place that limit order a little bit below the stop to kind of catch it in a down moving market. So I'm going to place my limit order that says I want to get out at this price or better. I am going to place that around 1230, just in case we have a wide spread on the option in that case. Whoops. Sorry guys, I'm going to have to rebuild that for us here. Stop limit. Okay. And we used 1590 and we did, what was it? 1272. That's what happens when you click all around the platform. It just kind of loses your space there. So we're going to go with 1230. Okay. So what is our downside risk in this case? Our risk on the trade is obviously the entire amount that we are placing into that trade. So the amount that we're risking is the premium that we're paying. We're buying 4 different contracts here, buying a long call. And that is going to give us a max loss of around $6,400 or so, which tells us we could actually bump that up to 5. So let's do that. Let's bump that up to 5 contracts there. It's going to give us roughly $8,000 that we would be risking in this one trade, which still gives us, stays within the parameters of the 5% of our account that we are risking into a trade anyways. Now, what we're going to do as well to see what our trade risk is going to take that 5090 minus 1230, and that gives us 3.6. We're going to take that times 5, and that gives us roughly 1,800 that we are risking within this trade. So that also stays within that 1% range that we have for our risk parameters for our account there. So looking at this, we see that this is a first triggers stop order, okay? We're going to leave our upside uncapped here. We are going to ride with this trend throughout the year, and we're going to have our stop to the downside. If the stock should move up in our direction through time, we're going to look to adjust this stop on a bi-weekly basis, depending on the pace of movement in this stock. So this is what we're looking to do with this first leap option here, because we are bullish. We are looking for stocks that are in uptrends. So we have our order good till canceled. We have our sell order in there, and I'm going to place this in the long options one. We're going to hit send. Okay, so that order is in and working there. Okay. I see a question in the chat. Would we consider a synthetic call or a poor man covered call trade? We are going to strictly stick with long options in this case. So sorry about that. But we're going to stick with long options just in this class. No synthetics or anything like that in this case. So let's go to the next one that we have on our list, and that is going to be FCX. So with Freeport-McMoRan, this is another one where we have seen that the stock is trading above its 50, its 200-day. It looks like it's in an extended trend kind of position right now. Obviously, we have had quite a bit of a move off of that recent break of resistance here. So if the trend does get exhausted, we may see a little bit of a pullback to a couple of these levels where these gaps occur, maybe one being right here, another being right here in the short term around 56 or so. So 56, 52 or so. If we see a pullback, technically that could be where price may find support in that case. If we zoom out a little bit further, like we did on that last one though, we can see a very, very long-term chart of Freeport-McMoRan, and this dates back all the way to 2008. I can take those highs and show that we are just now approaching resistance from a technical standpoint in Freeport-McMoRan. So this kind of gives you another kind of level to look at that we may be running into over the long term here. But nevertheless, it showed up on our scan. It isn't an uptrend. We are going to use this as an example today. So let's kind of follow some of the same rules that we were looking at before. So we're going to look for an expiration greater than a year. We're going to look for a delta in the 60s here. So let's look at the 21st of January 2028. We're going to give ourselves even a little bit more time with this one. So this gives us 738 days left until expiration in this case. Now let's look at what we have here. So I see right away our first strike that is in the money with a little bit of intrinsic value is that 55 strike. 1630 by 1720 is a tight bid-ask spread that does fit into our 10% criteria there. It does have quite a bit of open interest. It does have some volume on the day. In our delta, which tells us about the direction of the option, is roughly 68 cents here. So per $1 move in the stock, theoretically 68-cent move on the option. We have little to no time decay. And then we also have our Vega or our volatility measure telling us that if there was a 1% change in implied volatility, our option should theoretically move 29 cents in that case. Okay, so let's build, let us build this trade as well. I'm looking at the chat here. We would not do diagonals in this class. Long options only, friends. We do have a class on diagonals though. I love your guys' persistence here though on looking for other trades. It is awesome that we do have so many different classes for different types of strategies, but long options is the title of this class, so we'll just work with that. Let's see, as far as trend 1, 2, or 3, I believe that's a system that James Boyd uses. I personally don't use that system. So what I'm looking for in this sense with this example scan is looking for a stock that is technically in a intermediate and long-term uptrend. So hopefully that helps. And then, Paul, you crack me up. He's just playing. Let's see. Daniel, is your rule for buying a long option is to work at a 60 delta or an at the money strike price? We mentioned one of the things we are looking for is a delta in the 60s. So it does have a little bit of intrinsic value. A lot of times with these longer term options, it ends up being the at the money option just because that delta gets smaller and smaller the closer you get to expiration. So if I looked at that 55 strike, for a closer expiration, my delta would definitely be smaller in that case. So that's why we're going to stay in the 60s and still give ourselves a little bit of intrinsic value. So we are looking for a slightly in the money option in that case. Okay, let's see here. Let's look at building this trade here. So I'm going to take this, going to right click on the option, buy custom with a stop limit in this case, the same thing that we did before. We are going to bump this up to 5 contracts here on the 55 strike call. And let's use our 20% stop rule again on this option. So we're going to look to enter this trade at 16.75. Just a reminder, you're never due a fill at the midpoint, but we're going to start our price discovery here for this one at the midpoint here at 16.75. So that's the one we're going to go with. We're going to take 16.75 times 0.8 to give us what our 20% stop loss would be, which is 13.4. Whoops. 1340 in this case, okay? We're going to place our limit order a little bit below at 13. Okay. So we're giving ourselves a little bit of room there. Actually, we're going to give ourselves a little bit more room just looking at the width of this spread. It's almost $1 wide, so let's look at 12. Let's look at 12. Actually, we're going to have to tighten this up a little bit, actually. Let's go for a 15% stop. So we're going to take 16.75 times 85.85. We're going to go with 14.23. And then we're going to go with our limit right around 13.30. Okay. And the reason why I did that is because I think it would have put us too close to the risk that we're going to be taking on the trade. Because just a reminder, what we're risking is essentially our premium. So that's 5 contracts there that we are looking to place into this trade, risking roughly $8,400 in this case. But the trade risk that we are talking about is where our exit could possibly be, which is that limit order that says I want this price or better. That comes after that stop or that activation. And the difference between that and where our entry is multiplied by the number of contracts. So I'm going to take 1675 minus 1330 times 5. That puts us right at risking roughly $1,700 on this trade. That's why I kind of changed that to a little bit of a tighter stop in that case. A couple things that you could do when trying to kind of fit into those risk parameters. In this case, I just bumped up the stop, but other traders may just bump down the number of contracts as well. So traders could do one or the other, a mix of things. So that's just what we are looking at here. Again, reminder, the stop triggers off of the asking price. The limit comes after it. We have this good till canceled. We're going to hit confirm and send, place this in our long options one. We are double checking that and hit send. Okay. Do we have time for one more? Let's try one more, guys. Okay. AEM. We're going to move quickly on this one, guys. AEM, Agnico Eagle Mines in this case. So we just had that breakout of resistance here, a little breakaway gap, some would say. And it may retest this, it may not. Let's take a look at the long-term chart here as well. We have a very long-term breakout that we have seen here on AEM as well, and it has just been in an uptrend really ever since 2024 for this one as well. So if we're going to look to trade this one, keep in mind all the factors that we talked about before. We are looking for an expiration of greater than a year, a delta in the 60s with that option, or with that strike price being a little bit in the money, and we're going to place a stop on that one as well. So let's take a look at the 17th of June 190 strike call. We're going to scroll down to that one. That option has a spread of less than 10%, even though we do have a little bit of open interest, some volume there. Our delta is 66. We have a little bit of time decay, our theta being about 4 cents with each passing day. Our sensitivity to volatility being about 86 cents per 1% change in IV. We're going to do the same thing we did before. So buy custom with stop limit in this case. We can only trade 2 contracts of these because of the $10,000 that we are looking to risk into a trade. And let's take a look at where to place our stop limit in this case. So if I go to 46, if I take 46.50, multiply that by 0.8, that gives me 37.20, okay? And if I take this and make this roughly $35, I'm going to show you guys one more thing. This puts us over our risk. You can kind of see that there because the difference between 46.50 and 35, which is our limit just due to the width of the spread, that would put us above our $2,000 that we are willing to risk in one particular trade. So this is another one of those trades where we're going to make a little bit of an adjustment, make it a 15% stop, where we're going to take 46.50, multiply that by 0.85. That gives us 39.52. We're going to place our limit order a little bit below. That width of the spread looks like it is roughly almost $3 there. So to be safe, we're going to place this at 36.50. Okay? So this triggers off of the asking price. Our limit order is what's going to come next. Now we may get a fill at 36.50. We may get a fill at 36.50 or better. So that is what that order tells us that we are looking for. But essentially, in this case, if we take 46.50 minus 36.50, and we multiply that by 2, we are right within that risk parameter of our trade risk that we are looking at, which is roughly $2,000. So that is why we are doing that. I have a question in the chat about why we multiplied by 0.8 at first. That was just to show what a 20% stop would be on this option, because we did a 20% stop on the first one, but that just kind of shows you that a 20% stop doesn't necessarily work within the risk parameters. We may have to tighten that up or decrease the number of contracts. And in the last 2 trades, we tightened up our stop a little bit to be a 15% stop. So essentially that's saying that if the current price or if our entry price, if we lose about 15% on that option, that's where we would get out at. So that's why I chose 0.8 on the first trade, showed that as an example on the previous 2, and we tightened that up to 0.85 for 15%. So hopefully that helps there. So we have it good till canceled, 2 contracts, confirm and send. We're going to place this in the long options account. Keep in mind our max loss is roughly $9,300. Everything looks okay to me here in this sense. I'm going to hit send. Okay, now we have a position there. Wow, we got through 3 trades. We got through a scan. We got through all the leaps. So we covered a ton today. Just keep in mind some of those factors that we talked about. This scan is just, for example, educational purposes only. We talked about how the fundamentals and the technicals can kind of come together on these leap options. Keep in mind, you are not entitled to shareholder rights. You are not entitled to dividends, but it allows you to participate in a long-term investor type mindset with not having to outlay as much capital with a leap option in this sense. So that's why we wanted to go through this today. We gave you 3 examples. You guys obviously have 99 more to play with, but hopefully that helps for our session today. John mentioned he's having a leaping good time. I hope you had a leaping good time today, you guys. This was great. So thank you so much. Thank you for your engagement in the chat. Kevin, thank you for helping out in the chat as well. Please give him and I a follow on X. He is Kevin Horner CS. I am Rachel-CS. Please like this video if you had a leaping good time. Please give it double likes if you can, and subscribe to us on our Trader Talks Schwab coaching channel on YouTube. Stay tuned for my next class, Getting Started with Technical Analysis. We are going to talk about momentum divergences and where to look for, things to look for in that class coming up next at 2 p.m. Eastern Time. Later, traders.